So energy return on investment itself doesn't measure how quickly you get that energy back. And so another factor to consider is the payback period, like you mentioned. And so, for example, you can imagine two types of energy sources. One, you get a 20 return on investment over 5 years. And you get another one where you put in the same amount of energy and you get a 30 times payback, but it's over 10 years, right? And the question is, which one should you pick? Well, if you're trying to grow very, very quickly, again, if you're India, you probably pick the first one, right? You want energy now quickly, and then you can use that to make even more energy, and you can go up more exponentially. If you're already a sort of wealthy country with slow population growth, and there's just less overall rampant demand for more and more energy. I mean, people always want more marginal energy. I mean, if it was really cheap to fly private jets, I would, right? But it's not, and so we always have to economize. But for example, when you're you're coming from a small base, small changes in energy, like a small doubling of your energy rapidly changes your life. Whereas once you have a lot of energy, a little bit more doesn't really radically change your life. And so in a developed country, probably that second option is better. You're saying, well, we can put in energy, we can get 30 times as much back, and that's fine because we already have pretty much all the energy we want. We're just trying to grow slowly, and that's fine. And you're probably going to get better, unit economics of that energy. And so that's why, for example, in a lot of developing countries, you'll see a lot of coal usage. And the question is why? And it's not that hard to build a coal plant. It's quick. You don't need advanced expertise. You build the coal plant, you get a lot of energy quickly, right? Whereas a nuclear facility, it might have better energy return on investment, but that's going to take years to build. It requires, there's only a handful of entities in the world capable of constructing these, and then it's got a very long payback period. So it's a really good long-term investment, but some countries are in such impoverished state where they're trying to grow so quickly that they're not in a position where they can rely on those long-term investments quite yet. And instead they pick the more rapid turnover, the coal plants, the natural gas plants, things like that. I think that's how, yes, I do, because I think a lot of them are just focused on the cost of the energy and not the benefits that they provide. Especially in the developing world, I mean, having energy or not having energy is often the difference between life and death. It's the difference between being able to, your crops are starting to fail because of drought. Do you have enough energy to get water and irrigate them? There's a disaster that struck, a big storm struck. Can you get food in? Can you, do all that? Even like things like sewage and all. Part of why we had such a big population growth is because we have running water, we have water cleaning. All this is energy intensive, and it reduces our exposure to diseases. It increases our nutritional quality, unless we start going down like industrialized food processes, which unfortunately we've done. But essentially, we have better access to things we need to survive, and that's, I think, not factored enough into these ESG frameworks. They're kind of these one-size-fits-all approaches. And I think people don't realize, like, if we were to have a severe disruption to our energy production, that would kill a lot of people. I mean, that's about the worst ESG thing you can do. And so there can be impacts from pollution, obviously, from certain things. But then there's also, countries go through this development process and they have to get the energy that they need in order to expand their quality of life, expand their lifespans, make it possible for, premature babies to survive in hospitals. And they need all that reliable energy to get through that period. All that comes from having, abundant, reliable energy. So partially, so it depends on what timeline you look at. I mean, even in the 2010s, which was not a period of in most places, energy development, in North America, we had shale. And so we brought a lot of shale oil on quickly. And part of that was because of basically no cost of capital. So most of those companies were not profitable. They were growing quickly. They were not earning, free cash flows. And they were relying on all these investors pouring money in, buying their debt, buying their equity. When that started to dry up, now we're getting kind of a challenge in the shale patch, especially because you've also sucked out a lot of the, the lowest hanging fruit. You've gotten a lot of the easiest shale deposits, and now you're kind of moving on to, maybe the less ideal ones. There's still growth ahead, but it's not as quick as I think we're accustomed to. And so once you kind of tap out, shale, not that it's going to go away, but it's just going to maybe stop growing. Then the question was, where does the marginal barrel of oil come from globally? And of course, there are more places to look. You can expand oil sands. You can go in the Arctic. You can go in the China Sea. There's multiple more places to get it. There's places in Africa you can get it. But essentially, some of the oil that's left is just harder, either like in terms of geology or in terms of geopolitics. And then also when we've kind of hampered ourselves from going to get it, basically, I think we're just due for another capex cycle. And to the extent that we resist doing it, we're going to get these recurring inflationary spikes where, maybe when we're slowing down, when our economy is kind of in, pseudo recession mode, we can avoid inflation because we're not really using more energy. But if we're going on another growth cycle, those energy supply side constraints are still there. And so I do think that it's going to be a challenge. And then also, some of these countries have done things like windfall taxes on energy companies. And then if you're an energy major and you're planning about your capital expenditure budget, you're like, well, I don't even know how much of the profits we're going to get to keep. We have all the downside risk from developing a new project, but we have unclear upside potential of how much of that we'd get to keep. And so maybe we should just, buy back more shares, pay more dividends, strengthen our balance sheet. And that, basically changes the incentive structure for how, CEOs want to manage their companies. So I think so. But it's, both oil and copper, I mean, they're still off their like long-term highs, for example. And so it's not really gotten super severe yet. I think it's really that it's still building, right? I mean, it's hard to bring a new copper mine on. I mean, obviously it happens occasionally, but it's basically hard to build them as quickly as they used to be built. There's all sorts of environmental regulations. And a lot of those countries, it's understandable. I mean, basically, there's a history of, rich countries coming in, basically getting all their minerals and like leaving them with the mess and not necessarily a lot of the profits. And so you have this, this trade-off that always happens. And basically, I think we're due for another capex cycle in copper and a number of other things. And it shows up in some markets before others. And so, for example, gas is not a portable market. It's a much harder, it's not like you have one global natural gas price, right? Gas is a very localized price. It could be, 5 or 10 times higher in Europe or in Japan than it is in North America at times, sometimes even higher than that during the worst part. And that's because, in order to transport gas, you have to hyperfreeze it, transport it on specialized ships, and then unfreeze it. It's a very specific process. There's only a finite amount of capacity for that. Whereas oil is pretty easy to ship globally. So while there are a handful of different oil prices, it's a more global market for oil. It's a more fungible pricing market. And so we've had some of the energy crises show up in the less fungible energies. So oil never reached its prior highs, even when it was up to 120 barrel. That was not its high. Over a decade ago, it was higher than that briefly. Whereas natural gas did get to extraordinary heights over in Europe and Japan. And so I think that, later this decade, the concern is that you could have a similar spike in oil that you saw in gas, that basically, it's not gotten super bad yet. But if we continue to underinvest in that space while the global growth continues, if India keeps growing, if parts of Africa keep growing, parts of Southeast Asia keep growing, all these people from a low base of energy usage still growing up and kind of catching up to the developed world, that's a higher average base of energy consumption. And I do think we're likely to run into a more severe energy crisis in this decade if we